start.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the second best day of the week. It's also post-Fed rate cut Thursday, however you want to put that. Yesterday, of course, I was wrong. Markets also a bit surprised yesterday as well, as the Fed did come in and cut 50 basis points. Again, we had talked about how the markets were pricing in 50 basis points cut. Well, the markets were right. What the markets didn't get right, though, was the response in the afternoon to that actual rate cut. So a couple of the, Mike Leibowitz is here to join me this morning. We'll kind of go through all of the analysis this morning, talking about, the Fed rate cut, what it means, what was in the language. It was interesting because, now markets are having to figure out, well, how much more now will the Fed cut rates? And there was a little bit of hawkish language in the Fed rate cut yesterday. Talking, kind of tailoring some future rate cuts. So, we'll see how this all plays out. But again, yesterday the Fed did cut 50 basis points, which was a very large number. And we'll talk about the impact of that on the markets as we go forward. But, outside of that, there wasn't a lot of economic news to deal with, really, of any consequence. Markets kind of really traded sideways yesterday for most of the day. And then, again, as that announcement came in, there was a very big jump in the S&P for about a second. We're up about 1% at one point, and then markets sold off back into negative territory by the end of the day. So again, initially markets not knowing exactly how to deal with that cut. Is it really good? Is it really bad? This morning, however, very different story. They had time to think about it overnight. And futures are up very strong today, with NASDAQ up almost 2% coming out of the gate this morning. Dow is going to be up about 400 points. The S&P is going to be up about 88 points this morning. So there is a very big surge coming out of the gates. And one of the questions now is that with rate cuts now in play, and now bringing that down 50 basis points and more coming, right? More rate cuts coming. Will we finally start to see a rotation into some of these other markets that have not performed? Now, first of all, rate cuts are great for mega cap companies, right? So whenever we cut rates, growth companies do very well. So the mega caps should respond well to rate cuts, but lower rates also mean lower rates on floating rate debt, which should start to potentially play in, lowering servicing costs for small and mid-cap companies that are highly leveraged. Value-based companies theoretically should start to get a bid now with, lower interest rate financing costs as well. So, we'll see kind of how this market plays out. But this morning, futures are pointing up extremely strong. And, that kind of gets us into, what you need to know before the bell this morning. So, yesterday, as I said, Fed cut rates. And here's the interesting thing about yesterday. So we'll zoom in here just a little bit. The market put in what's called a shooting candle yesterday, and that was where the market opened up well above the market, sold down everything. We actually kind of broke out to new all-time highs yesterday, early in the morning. Sold and then sold off a bit, and then again that really sharp spike took us to all-time highs as the Fed announced that 50 basis point cut, then gave all that back up and ended negative for the day. So first of all, we've had this building resistance at these kind of all-time highs now for the markets, and that big reversal really kind of was a rejection at that major kind of overhead resistance. So I kind of went to bed last night going, okay, well, we got the Fed rate cut in here at all-time highs and big rejection, so we should get potentially some follow-through selling in the morning. Well, that's not going to be the case. This morning, we're going to break out again to all-time highs. So again, if this breakout is going to hold, now we're on a buy signal, as we've talked about before. So again, that's supportive of this move higher that we've had here for a while now. We got this buy signal back, about a week or so ago. Markets are not extremely overbought, so there is the ability for this market to try to push a little bit higher here today, and we're going to be overbought today with this rally. And of course, markets can stay overbought a little bit longer than you would think. But again, we get a breakout today to all-time highs. If it can hold that today, right? If we don't give this all back up today and finish back negative, you'll have a breakout. And if we can hold this through Friday, you'll have a breakout, which should allow markets to start to trade higher here short term. But again, we are kind of moving into overbought territory. One of the other things that that we've kind of been paying attention to is that we've had this very, very nice rally in the markets, but you've had a negative divergence in both relative strength and momentum. So, you do have underlying participation that is weakening in the markets. However, retail investors and professional investors are underweighted equities right now going into October. So again, if this market does break out to all-time highs, that catch-up in allocations could provide a bid to the markets. Now, that's the bullish side. The bearish side, of course, is we have buybacks going into blackout. That's removing a buyer from the markets. And again, we still have the risk, kind of upcoming election risk and other things that are just ahead of us, earnings season about to kick off, that could certainly limit upside here near term. So again, there's nothing bearish about the markets right now and what's happening. And today, if we do break out to an all-time high and are able to hold that through Friday without giving it back up again, that would be a bit of a bullish development. On another side, though, talk about bonds here. We've been talking about for a while that bonds have been very overbought. Yesterday, we saw a fairly decent reversal in yields after that Fed rate cut. Bond prices did come down. We're about to touch the 20-day moving average. So this is the first decent little correction that we've had in bonds here short term. So that should provide us a setup. We'll see how bond markets respond today to this 50 basis point cut if they start to kind of think about the risk of a further economic slowdown because the Fed is cutting rates now. Is that because of economic weakness? The theory of the stock market is that the market's cutting here, more liquidity, more accommodation, no recession. Bond market still suggesting that there's recession risk. So we're going to see how this kind of plays out here over the next, a month or so. But we're finally getting that initial pullback to support to potentially allow a better buying opportunity to add exposure to bonds. Now, in particular with bonds, this is TLT, by the way, just about to trigger a MACD sell signal. And we're not oversold yet to any great degree. So we do have some more downside risk here. So again, be careful jumping in right here. This is the first little decent correction we've had, but I think it might go a little bit further. We could just kind of chop around at this level. We'll see. But if we do get a pullback to around 96, 97-ish, that should be a fairly decent entry point to add exposure to bonds at that point. And that'll be something that Mike and I have been looking for as well, is kind of finding a point to increase our duration, shift some of our really short-term into a little bit longer-term bonds. But we need a little bit of a pullback here to do that. As I mentioned, one last thing here. As I mentioned, small caps and mid caps should actually start to get a little bit better performance. They haven't really performed all that well. Here was this big spike we had in small caps earlier this year, and everybody's like, oh, small caps are coming back, and then we completely gave all that back up. Yesterday, small caps performed decently. They performed better than the S&P yesterday, but still just stuck in a very kind of long-term sideways trading action that has really just been an underperformance relative to other markets. So, again, we'll see if lower rates begin to provide a bid for small and mid-cap companies. That'll be something that we kind of keep a watch on. Value companies also. That's what you need to know before the bell this morning. We got a lot of stuff to get into about the Fed rate cut. So we'll come back, pick up with Michael Liebowitz right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. Michael Liebowitz joining me this morning to talk a little bit in detail about what happened yesterday with the Fed rate cut. Of course, Jerome Powell yesterday during his press conference, kind of rephrased and repeated the sentiment that, the U.S. economy is in good shape. Unemployment is coming up a bit. Inflation is falling. So it's all in good, and we're all in a really good position right now for getting inflation back down to target levels without going into a recession in theory. And so he wanted to, and so this rate cut, bigger than expected, of course, as I said, at 50 basis points, is supposedly there to help continue this improvement in inflationary decline, as well as, stabilizing the employment. So again, 4.1, 4.2, 4.3% unemployment, that's historically what we determine as full employment, right? So, if you're around 4 or 5% unemployment, that means that in theory, right, 95% of the population has a job. So you're near full employment between 4 and 5%. Now, we got down to sub 4%, over the last kind of 10, 15 years, and that became the kind of the new mark. But that was extremely low. When you're in the 3% range of unemployment, that's historically very, very low unemployment levels. 4 to 5 is normal. So the theory here is with Jerome Powell is that this rate cut is going to help stabilize the employment picture, help stabilize, keep bringing inflation down towards their 2% target, and everything should be fine. as he quote here, I'll just read a quote to you from him. He says, "We don't think we're behind the curve. We think this is timely, but I think you can take this as a sign of our commitment to not get behind." He was trying to put away a lot of these criticisms that he waited too long to cut rates, and now he's trying to play catch up, and that was the reason for the big move. So again, we'll see how this all works out. The market initially took it negative. As I said yesterday, everything sold off, and then this morning, I guess they thought about it overnight, and now they're super excited about a 50 basis point because we're going to have a super strong opening this morning. But with that said, Mike, what was your kind of takeaway from the conference yesterday? Anything surprise you?
The 50 actually didn't surprise me. I know we were on here last week, even earlier this week, saying that 25 is baked in the pie. But, we saw Nick Timiraos, a.k.a. the Fed Whisperer, come on and basically, via the Wall Street Journal, basically tell us that 50 is a distinct possibility. We saw Fed funds futures on, I think it was Tuesday, starting to price in, 2/3, 3/4 of a chance that the Fed would go 50. So by the time, the meeting came at 2:00 yesterday, I was, expecting 50, even though I, thought it was going to be 25 the whole time. Here's where I think the Fed is kind of screwing up communications. And I think if they could change their tone a little, it would make their job a lot easier. And I think it would actually ease the markets a little bit. And what he needs to tell us, and what we know, is that Fed funds were too high compared to where inflation had been running. Inflation spiked. They raised Fed funds significantly, right? Well above where Fed funds had been for a long time. Inflation has been coming down steadily, and the Fed is gaining more and more confidence that inflation will hit their 2% target next year. And in fact, they even lowered their estimates for inflation this year and next year in their quarterly projections, which also came out yesterday. Mm-hmm. So I think if the Fed would have a tone that was more like, we had Fed funds very restrictive, too high, we're bringing them down with inflation, we're watching the labor market, we're not overly concerned, but we do want to make sure the labor market doesn't get weaker. And what we're doing now is normalizing interest rates. We're not cutting in the traditional sense that we're trying to pick up the economy. Mm-hmm. Right now, we're trying to get interest rates back to where they should be, given inflation, given employment. And when you think about it and look at it in that lens, you realize that still Fed funds are way too high for the way the economy's growing and for the way inflation is trending. So the Fed still has some work ahead of them, even if the economy just is not going into a recession, if we're not weakening, if we're just staying where we're at. The Fed has to get Fed funds down to 2.5% to 3%. So I think the way they acknowledge this and the way they talk about it could be better. And certainly labor, the other, I think the important point that he made over and over again, they made it in the statement, but he repeated it constantly through his press conference, was that the way they look at the labor market and inflation is balanced now. So they're not solely looking at inflation anymore. They're focused on the labor market. So as long as inflation continues to stay steady or come down, I think they're going to take their lead from the labor market. And I think what that means is they'll probably go 25s at, the next, 4, 5, 6 meetings, however you get down to 3%. But if the labor market continues to show signs of weakening, it certainly introduces the odds of a 50.
Yeah.
So I think what that means is all labor data becomes much more important to the market. So, in 2 weeks, we'll get the BLS employment report, ADP and JOLTS. And then at various points, we get the manufacturing and service surveys, the ISMs, the regional feds, and they all have employment indicators, the University of Michigan survey. So that's kind of, I think, where we have to pay a lot of attention to going forward to understand what the Fed may or may not do.
Well, and look, there is a risk to cutting rates, kind of this aggressively, which is, if we take a look at the GDP report, the Atlanta Fed for third quarter, just came out, and they upgraded their GDP estimate for the third quarter of this year up to 3%. So, we've been running at 2.5%, 3% on economic growth. One of the potential byproducts of this is that by cutting rates, you get a lot of refinancing activity in theory going on. You start getting more economic activity coming in from lower interest rates, and that actually brings inflation back up. So one of the risks that the Fed may be facing is potentially a pickup in inflation rather than a continued decline. What do you think?
But here's the question: who's going to refinance? Who has a mortgage that's 7 or 8%? And the answer is
not houses, corporations.
Corporations too. So what they were really smart about in late 2020 and 21, they refinanced a ton of debt. They issued a ton of debt at very low rates. So they haven't been putting on a lot of debt at high rates to refinance. So I think, and this is a problem for the Fed. Typically, when they start cutting rates, you get mortgage refinancing, corporate refinancing, new people wanting to borrow, but rates are still very high compared to where they've been. So I think the marginal benefit to the economy is much less, at least at these initial stages of rate cuts, than what we've seen in the past. Now, once they get down to 3%, I think the benefits start accruing much faster. But I think that's the other reason they want to get it down back to normal so that when they do something, it has a bigger effect. I think the effect is very minimal right now. Just like, we've seen this, it's been taking a very long time for high interest rates to even have some effect on the economy.
Right.
And that's because so many people refied, whether it's mortgages or corporate loans, so early in the game. The only one truly affected has been banks to some degree, holding the bad debt, and the U.S. government with the high interest expense.
Well, that's not really the case, Mike. You're right about that companies took advantage of low rates to refinance, but that was all large cap companies. Small cap and mid cap companies across the country, and especially private companies, they're locked into a lot of floating rate debt that has gone up to fairly high levels. Then the other side of this equation is that, there's a lot of people in the construction real estate business that have just been chomping at the bit for rates to come down to bring up cap rates so it makes sense to go build projects, do CapEx, et cetera. So again, lower rates, even at these initial stages, may start to, and again, I agree with you that the first 50 basis point cut's not going to mean a whole lot, but if we bring this down 1% or 1.5%, you're potentially going to kick off. And particularly with the economy growing at 3%, if you start getting stronger rates of economic growth because you pick up activity because of lower rates, you're going to get a pickup in inflation. And then that's going to put the Fed in a much more difficult position.
And look, that's completely fair with the small and mid cap companies and some of the builders. I get it. But, the large caps are really not going to benefit much from this, and certainly not. And, personal consumption won't either, because that benefit of refi will be so small. So, yeah, there are, pros and cons. Is it inflationary? In the past, rate cuts really haven't been that inflationary. But if you push, economic growth from 3% to 4 or 5%, that starts becoming inflationary. So we'll see what kind of effect these rate cuts truly have on the economy and ultimately inflation.
Yeah. No, and look, and there's a lot of issues. We've talked about the issues with commercial real estate. There's a lot of problems going on with commercial real estate. There's a lot of deflationary activity that is out there. Just one of the, and again, kind of my point is that when you start cutting rates aggressively, you do run the risk, especially if economic growth was closer to 1% versus 3%. I wouldn't be even concerned about the risk of an inflation pickup. But when you're already at 3, and you want inflation at 2, you're already running the risk with the economy growing where it is that inflation will pick up just to catch up with 3% economic growth. So it's going to be interesting to see. I mean, I don't know how this is going to play out.
Although keep in mind, the Fed's projection for GDP for year end for the full year is 2%.
Well, the problem is the Fed's never been right with their predictions. So then there's that. We'll come back after the break with Michael Leibowitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Today is a very sad day because we had a very serious set of deaths in our house.
The Real Investment Show podcast.
It's been just a very traumatic few days. We lost our new coffee maker, we lost our air fryer, and we lost our oven when this power surge came through the house.
Same show, your schedule.
That's how big the surge was coming through the house, but I've not had coffee for 2 days, so just beware. I don't know what you're going to get this morning on the show, but
at realinvestmentadvice.com.
I'm a little cranky.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show. So talking a little bit about the 50 basis point cut. Again, there's going to be lots of commentary about, kind of what's next, what it means for the markets. And honestly, nobody knows. I don't know. Mike doesn't know. We don't know what's going to happen, how this is going to play out. We can make some assumptions based on history. What we do know is that of the last 20 times that the Federal Reserve cut rates at all-time highs, the market was higher 12 months later. Without fail, 100% of the time. So, again, I don't know what this means, but maybe good for stocks. We'll find out, how this all plays out. It is interesting, because there are a lot of bearish kind of commentaries out there. And again, we try to analyze, and this is what Mike and I are discussing right now, is we're talking about both the bullish and kind of bearish outcomes of cutting rates in this environment. We have reasonably strong economic growth. We have reasonably low unemployment. You're cutting rates, which will provide, better financial conditions for borrowing money, et cetera. But as a good example, the last time that the Fed cut rates when financial conditions were already this loose was 34 years ago. A lot of people are pointing back to 1995 right now, saying, well, look what happened when the Fed cut rates in 1995. There was no recession and markets just kind of went higher. But the difference is that in 1995, the yield curve wasn't inverted. It didn't invert until 1998. It uninverted in right before 2000, and then you had the dot-com crash. This time we have an inverted yield curve that's just now beginning to uninvert. So again, there's, the problem with all of this where we are is that we've got a very bullish market. We've got a very optimistic market. Then you have all these other kind of indicators that are sitting out there that says, hey, maybe you shouldn't be so optimistic. And this is the challenge for investing capital right now. And this is why, we kind of go back to what we talked about in the before the bell this morning. We've got a market getting ready to break out to all-time highs. That's bullish. And despite all this other conversation, it's something that we need to be paying attention to, because markets are going to do what markets are going to do regardless of the other things that we think about. And we can certainly come up with all the reasons why we shouldn't invest. It's easy to come up with reasons why we shouldn't invest capital. That's easy. Sometimes the hard part is figuring out how to invest capital when you really don't feel like you want to. And that's unfortunately kind of where we are right now. Historically, when the markets have been doing well and the Fed cuts rates, they continue to do well for a period of time. Now, it doesn't mean you don't eventually get a decent correction. The Fed cut rates in 2019, right? And we had the 2020 pandemic shutdown. So again, 12 months later, the markets were higher, but then you had the shutdown. So, those are all the things that you kind of have to factor in to your portfolio management structure, is that there's so many different variables that come into play. And here's the other interesting thing about this. There was this great chart this morning put out by Goldman Sachs. And it went back in history and it looked at bull markets and bear markets and corrections going back through history. And what's interesting is that bear markets and corrections were much more common prior to the 1990s. Post the 1990s, they have become less and less common along the way. And in other words, big bear markets, like the dot-com crisis, like the financial crisis, are getting much further apart than they used to be prior to the 1990s. And this is because of decimalization, buybacks that have been going on for the last, 24 years. The impact of just more real-time access to markets that has brought in a lot of retail traders. More households are trading their own portfolios now. They're involved in the markets. Also, hedge funds and computers and all these other private equity have exploded over the last 20, 25 years. They have become just a massive balance of capital to invest in markets. And so there's been a very significant change to the structure of the overall markets. And then combine that with Fed liquidity, quantitative easing, all this other stuff that we're doing, combined to that. And that's why these big bear markets, these big corrections are becoming much further apart. And when we do have a correction, like 2022 is a good example. You had a correction, we were down about 20%. That's it. The corrections are becoming even more shallow across time. We've had a couple of corrections this year. We had 10%. Last year, we had a 5% in April. We had another 8.5% in July. We just had a 4% that we went through. So the corrections still occur, but they're very quick. And this makes it even much more difficult to manage capital, trying to navigate a market that kind of consistently rises with these very small, quick corrections along the way that give you very little opportunity to invest capital. But just putting this all in perspective, the market is up 40% from the October 2022 lows. There have only been 3 other periods in history where the markets have been up 40% from these type of lows without a significant correction along the way, and that was going into 1929, 1987, and 1999. So there's that. So Mike, kind of the point I want to make here and get your feedback here is that, it's great that the Fed's cutting rates. The markets are certainly optimistic about that right now. That doesn't remove risk from the markets, but this is, as I was saying, there's there's a lot of people expecting the next big crash is about to come. We're about to, the dollar is going to lose its purchasing power parity, basis. We're not going to be the reserve currency anymore. And there's all these other things that are going to happen. Inflation is going to come flying back. There's lots of reasons to be bearish, but again, markets are not really suggesting that. And that's the challenge you and I face.
Now, here's the dirty truth. Ever since Greenspan in the 90s, the Fed has become the manager of our economy, right? If you really think about the recessions that we've had, 2000, 2008, and 2020, they have all been crisis driven, right? Kind of event driven. The Fed has really managed the economy, and I would say propped up the economy so that we don't have the recessions that we used to have, kind of more the garden style cyclical economic growth and decline. So, in 2000, dot-coms just got grossly over their skis, crashed, and the lack of confidence in the stock market forced the economy into a recession. 2008, a remnant of the Fed pushing low rates mortgages, you created a mortgage crisis, which hurt the stock market and also fed into the economy. 2020 was a little bit of a different animal, but it was a crisis nonetheless, an event. So, the Fed is intent, and they've made this very clear and increasingly intent to make sure the economy doesn't go into a recession. So as long as everything is more or less okay, the Fed can do a lot of things to help boost the economy. But it's when something happens that's a little bit out of their control. If stocks get too high and they crash, if there's war, if there's a pandemic, who knows what it'll be. But you have to keep in mind as an investor that the Fed thinks their job is to support the financial markets, and prices are very elevated on most traditional valuation bases. They don't care. Their job is to keep them there. They're never gonna put out that irrational exuberance statement that Greenspan put out 30 years ago, because they realize there's a tie between the stock market and the economy. Mm-hmm. And if people are not confident in their wealth, and we saw that with the housing crisis in 2008 and the stock market in 2000, if they're not confident with their wealth, they're going to spend less. And that's how you get a recession. So they're managing the markets, they're managing confidence, and ultimately the economy. So, as an investor, that becomes really hard because you're looking at all kinds of data. Stocks are very overvalued, but you have this massive liquidity source. And it's not just the Fed. The other central bankers are on board, and they play a role in this too to some degree. So, it's an uphill battle if you're betting on the market crashing. The status quo is for the market to keep rising because that's what the Fed wants, and that's what will keep the economy rising.
Right. You made a very good point, which is, other central banks right now, the UK, the ECB, and Canada have already cut rates. But there's a lot of countries, and again, even those central banks really kind of watch the Fed, and they really kind of follow what the Fed does. And so, yesterday's rate cut's now a signal for, central banks like South Korea, India, and others that have been waiting on the Fed to start cutting rates. So we're potentially about to start to move into a global easing cycle that is going to pull rates down, globally and more. So again, everybody kind of looks at the Fed for, and really kind of the U.S. market. It's a very interesting stat out this morning, by the way, about U.S. markets. The U.S. market makes up 60% of all the global stock markets. So 60% of all equities that are traded are all U.S.-based companies. But the U.S. only makes up about 24% of global GDP. So again, we have a massive pull of capital into the U.S. And again, this is another reason why markets have changed over the last 25 years, is that pull of capital into the U.S. is also what's keeping markets from declining, because our market is multiple times larger than our GDP, which isn't the case for other countries around the world. All right, Be right back. Wrap up the show with Michael Leibowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, real quick, my wife has been having dinners. There's a liquefied natural gas, clean natural gas convention in town right now. So every night she's been out at the convention, having dinners, doing all this. So she's not getting home until 10:30, 11:30 at night. And man, is she cranky. Because, she gets up with me in the morning. So her sleep schedule, and my wife loves her sleep. I mean, if my wife had her choice of a vacation in some exotic location or a week where she could just sleep in bed all day, every day, she would choose that hands down every single time. So, I mean, just she loves her sleep, and she is just not getting any right now. And I'll be glad when this week is over. But if I don't show up on Monday, send the police. Something has happened over the weekend. And I probably said something I shouldn't have, but there you go. Couple of things. So I realized, how long have we been in this new studio? What, about now? About 5-6 years we've been doing this?
7 years.
7 years now?
Yeah.
And I just realized now, after 7 years, we put the clock in the wrong place. We have a clock that counts down the minutes. Yeah. So that, I know when we're about to go to break, and I know how to, I need to get out of a segment. And the problem is the clock is over here. And that's why you see me on chat look off to the side, because I'm looking at the clock. We should have put it over there where I could see it in front of me.
But I'm the one that needs to see it.
Well, I need to see it too. But it's over there.
We can get you a second clock.
It's fine. It's fine.
It's just a matter of
money. Yeah, I know. I got to get rid of Mike's face too, because that bugs me over here.
Thank you.
Anyway, get ready to wrap up the show. So, yes, Sharp's Law in our chat said he loves the Spartan helmet. I bought that for Brent when I was on our family trip in Greece because he says I never bring him back presents when I travel. So I bought him back a present. Yeah. We have lots of little tchotchkies in here that we've picked up over time. So, we have to rotate them every now and then.
It's a radio studio museum.
Exactly. All right. Real quick, again, markets are actually kind of in, I'm just looking at futures right now. Dow's now up 473 this morning. S&P is up 93 and the NASDAQ is up 400 points right now. It's going to be a really strong open for stocks this morning, again, after yesterday's kind of initial knee-jerk reaction. But, one of the things that, is Mike and I are still kind of paying attention to is the underlying economic data. And there is still signs of weakness in that data that have not really, kind of started to recover. Again, we're watching employment data, we're watching the manufacturing data, we're watching a lot of the services data. That continues to be, fairly weak here. And again, we're about to move into earnings season. And one of the things that is fairly telling is there has been a very, very sharp contraction in earnings estimates going into quarter three over the last month. Over the last month, analysts have been very busy cutting their estimates for Q3. This is not uncommon, by the way. We talk about this every earnings season, and that's why we call it millennial earnings season, because everybody gets a trophy because we cut the bar so much that everybody kind of beats them. But this is going to be, really important as we start to kick off earnings now in about 2 weeks. So beginning October, that is the beginning of the third quarter reporting period. We're in, as I said earlier, we're now moving very quickly into full blackout for share buybacks. And those share buybacks tend to go into blackout about 2 weeks, roughly, give or take, ahead of earnings. And then once the company reports earnings, then they can start buying back shares the next day. So again, there's no real law about this, right? There's no rule that says, oh, you have to shut down buybacks 2 weeks prior. But companies have kind of adopted this habit of doing this and closing and kind of closing down buybacks a couple of weeks prior to earnings just to avoid running foul of the SEC. They don't want an SEC investigation for potentially insider trading or, leaking of confidential information that isn't public knowledge. There's a lot of risk to companies if they're buying back shares really, really close to their earnings announcement. So there's this rule of thumb. It's different for every company. But it's about 2 weeks ahead of announcements. And so we're moving very quickly into that period of removing a primary buyer from the markets. And again, while markets are very, going to be very strong this morning, there is that pull right now on prices. So again, we may have a very strong update today, and the question will be whether or not that we can sustain it. We've seen days before where we've opened up 1.5% or 2% and finished the day negative. So this is going to be kind of an important day for the markets to determine if this breakout can hold and can the market sustain the breakout even if it does. I mean, we could break out today and then give it all back up tomorrow too. So, we've got to sustain the breakout in order to say, okay, finally we've broken out, we're going to make the next leg higher. But Mike, is there, kind of just as we kind of start to move into this, any observations from anything you're looking at right now?
Well, I think what was interesting is the market's reaction yesterday was meh, right? It jumped initially on the news, it traded down, it moved up a little, but by the time the market closed and U.S. investors went home, the market S&P was down, I think, 10 or 15, something like that. Yep. It was basically flat. Right. It was a non-event, despite all the hype, it was a non-event day during U.S. hours. U.S. investors go home, and then we come back in this morning, and between Asia and Europe, they significantly bid up the U.S. stock markets when volume is very light, when there's not much liquidity. So, you have to be a little careful. We know, the initial vote from the U.S. was it was a non-event. The vote from foreign investors was let's buy this thing. This is awesome. So, we'll see what happens when the market opens today, if it holds on to these gains, if it furthers the gains, or if it starts leaking. We've certainly seen that in the past, all three type of market moves after the Fed. This isn't uncommon, where the market kind of does nothing on news, and then you see in the overnight hours that it either goes up or down a lot. I also saw a stat. I wish I had the numbers, Lance, but something like 80% of the S&P returns over the last, I forgot, 20, 30 years occur in the overnight hours, right, not during U.S. hours. So that's when games can be played, because there's not a lot of liquidity. And, you can really push around markets with the futures market. So again, it's something to watch, but certainly the initial vote is that rate cuts are positive. Now we go back to watching data. The next set of data is going to be PCE inflation, which will come out probably next week. And then the employment data, which again will be very important to watch. And every Thursday we have initial jobless claims. So I think that'll kind of steer the market. But, and then ultimately we have earnings come October. So, there's a lot on the plate to keep an eye on.
Well, and just real quick, just to wrap up the segment, because we only got about 2 minutes, but, bonds we have a lot of people that are invested in T-bills and money markets and those type of things. Kind of the T-bill and chill has been great for the last couple of years. Well, they just lost half a bip on that overnight. The question though now becomes is, kind of what do you see here for the bond market after this 50 basis point cut?
Look, I mean, we're very overbought here, so it wouldn't surprise me if we go nowhere, or if yields kind of gently go a little higher, prices go a little lower, and that could last for a month, maybe even into the election. But ultimately, I think that yields are still too high for the economic and inflation growth rates that this country has. So they're going to come down with Fed funds. Now, the front end of the market, the very short maturities, the 2 years, the 3 years, the bills, all those yields will come down quicker than the longer end. But nonetheless, I think that we're on a path for lower yields, barring some sort of change in the inflation outlook or much stronger economic growth. And obviously, with the election coming up, depending on who wins and who takes the House and Senate, that may change our view as well. But right now, I think we're in for a period of consternation, consolidation, maybe higher yields slightly. But it's probably going to create an opportunity to either buy more duration, extend your duration. But, the problem bond investors have right now is that they are sitting in T-bills, sitting in money markets. And all of a sudden, those rates went from 5.25% 2 weeks ago to 4.75%. And they're going to drop every day going forward. Every day, money market yields are going to be falling. And at some point, that money is going to leave the money markets and probably stay within the fixed income markets, but start chasing 2 years, 3 years, 5 years. Some will be a little more risk taking and go out to 10 years, 30 years, and others will just go to shorter maturities. But I think we're going to see that money market money start to move a little bit.
Okay. All right. Again, we've got a lot of commentary about all of this on our website. Newsletter this weekend will be talking a little bit more about this and kind of positioning and looking at the technicals. But again, the big thing over today and tomorrow is, can this breakout hold? That's going to be the first big test for the markets. We've been consolidating, bumping up on those highs here 3 times now. So again, can we break out and hold this breakout? That's going to be the first important test. If we can do that, then we've got something to talk about next week. We'll see what happens. Be back tomorrow. Of course, Danny Ratliff and Richard Russo here for Financial Fitness Friday. Newsletter on the website this weekend. Our daily market commentary is up and running right now on the website, realinvestmentadvice.com. Don't forget, like the channel. We like this show. We need the help. So we appreciate everything you do. We'll see you back here tomorrow. Have a great day.